AgriTalk is brought to you by AGI SureTrack. Proper grain storage management leads to increased profit. With in-bin monitoring, you can hold grain, improve quality, reduce storage costs, and more. Bin Manager delivers all of that with automated bin monitoring from AGI SureTrack. Okay, corn had a rough close. Bean prices backed off to mid-range. But you know what? Wheat did wheat things and sprinted into the weekend with new contract highs in spring futures. Cattle futures on the defensive to wrap up the week, while lean hog futures worked hard to reject last month's price lows.
Live from the waning hours of the week via Farm Journal broadcast, this is AgriTalk. This afternoon, we'll chat with Brian Hoops from Midwest Market Solutions. I'm handsome newsman Davis Michelson, and now the host of AgriTalk, Chip Flory.
Hey, buddy. Yeah, waning hours, but it ain't over till it's over. We got a lot to talk about with Brian Hoops. Going to be it's always a good conversation with Brian. So, yes. Looking forward to it. And after the kind of volatility and markets moving in opposite directions like they did, well, I shouldn't say opposite directions, but some moving more aggressively to the upside than others, it's going to be interesting to get Brian's take on it. Plus, the bear spreads. The bear spreads worked in the corn market this week, but corn was kind of an underperformer compared to everything else. I'm not exactly sure what to make of that. We'll see what Brian thinks when we get to him here in the next segment. So, all right, the weather. It's got to be a big part of the conversation with Brian today. And I'm not so worried about getting the weather forecast right, because the weather forecast, what it is right now, is probably going to change by the time we get to Sunday afternoon before the markets reopen for the week. Yeah.
For sure.
But how much influence should it have in your risk management decisions? How much influence should it have in the strategies that you choose to use to manage downside price risk? Those are some of the things that I want to talk with Brian about. Plus, Brian gets out and gets around the Western Corn Belt in particular. I want to see if he's had an opportunity to go out and take a look at some of the crops out there and how things might be looking.
Man,
we're going to get. We're going to get to this, too, and we'll get to it in the wheat news. Well, you know what? Let's just go ahead and jump into the wheat news, and we'll talk about this afterwards.
Sure thing. Well, September spring wheat futures gapped higher in the overnight, with the weather forecast calling for heat and dry conditions in the U.S. Northern Plains and Canadian prairies. Spring wheat crop conditions are bad and getting worse in the days ahead. The low-range open and high-range close in September spring wheat today puts the market in position for a breakaway move on Monday. Selling interest in winter wheat futures is also draining out of the market, with China buying 134,000 metric tons of U.S. soft red winter wheat, and with the 2021 harvest well past half done. September hard red winter wheat 11 1/4 cents higher, 651 1/2. September soft red up 20 1/2 cents, 692 1/2. September spring wheat closed at 917 1/4, up 23 1/4 cents. Chip.
Yeah, and you know, those winter wheat contracts, they continue to run into the overhead resistance at what I believe was the July high in those markets. And you know, that news, that technical analysis might have been written just ahead of the final surge to the upside in spring wheat, because maybe this was the breakaway move, Davis. It very easily could have been. We'll talk to Brian about that coming up here in just a little bit. But my goodness gracious, when you get the gap up and a session high close and 20+ cents higher in the new crop contract, I don't know what else is a breakaway move. And how about China? How about China coming in? 134,000 metric tons of U.S. soft red winter wheat. That's another reason, the demand coming into the market, that we talked about yesterday with Dan Huber on why wheat could be the long in a wheat-corn spread going forward.
Well, weather is capturing corn traders' attention right now, but some market watchers are keeping close watch on the export market. While corn export sales have slowed lately, additional risk to the Brazilian corn crop is reportedly causing Brazilian exporters to cancel sales to keep enough corn in Brazil for domestic users. That ultimately could send more demand, Chip, even old crop demand, I dare say, to the U.S., and will put the U.S. in a clear leadership role for 2021 and 22 exportable supplies. Technically, December corn took another bite out of the wide July 6th downside price gap again today, but increased selling interest generated a downside reversal and a session low close in new crop corn. September corn futures 8 1/4 cents lower, 5.56. December corn down 4 1/4, 5.52. March corn closed at 5.59 1/2, down 4.5 cents.
Yeah, tough week. Tough way to wrap up the week, I should say, with that downside reversal. But we've got to keep a close watch on export demand going forward. Real quick. On the week, September corn was up 26.5 cents. Dece corn on the week was up 35 cents. So there's that bear spread really working. And I didn't hit you with the weekly changes on wheat. I'm going to do that right now. September SRW up 77.5 cents. September HRW up 57.5. And ready? September
I'm ready.
spring wheat futures up $1.03 on the week. Thank you.
Despite this week's disappointing data that suggests USDA will have to trim its old crop crush estimate in the August supply and demand report, both soybean meal and bean oil have been higher on the week, helping bean prices also trade higher. Much of the buying interest in the bean market this week, however, was driven by the extended weather forecast, with hot and dry forecasts slipping into the first week of August. November bean futures filled the July 6th downside price gap on Wednesday, and have established the top of that gap at 13.82 1/2 as a new level of support. August bean futures 7 1/4 cents higher, 14.54 3/4. September beans gained 11 3/4 cents, 14.06. November bean futures closed at 13.91 3/4, up 11 3/4. Chip.
See, it makes me think that there are still that the old crop market is still going to have an influence on how the bean market trades into the new crop harvest. Even how the corn market is going to trade into the harvest. And the reason that I say that is because while the bear spreads worked in corn this week, the bull spreads worked in beans. And you had meal working to the upside. You had oil working to the upside. So on the week, August soybeans up 75.5 cents. November beans up 62.5 cents.
December cotton futures tried 3 times this week to get to a 90 handle and failed. Chart watchers might be looking to use the first spike of resistance at 90 cents as an opportunity to take some profits on long positions. October cotton was 86 points higher at 90.70. December cotton jumped 88 points to 89.93.
And on the week, December cotton was up 222 points. Big week. It was a good week for cotton.
Live cattle futures rallied hard at the start of the week and spent the second half of the week giving those gains back. August futures are in position to test support at 120 on Monday's open. August live cattle 95 cents lower, 120.17 1/2. August feeders 175 lower, 155.62 1/2. And quickly on the snout side, August lean hog futures gapped higher on Monday morning, extended the rally with a second gap on Tuesday, and then ran into some profit taking at midweek. August lean hogs $1.35 lower, 105.65. Dece up 107 1/2 today, 83.87 1/2. Chip.
Yeah, a lot of the strength in the hog market this week, just on the idea that maybe the price pressure that we saw in June was a bit too much and was a bit overdone. August live cattle on the week up 95 cents. August feeder cattle futures on the week down $3.55. And get this, August lean hogs up $4, 7.5 cents. All right, Brian Hoops, Midwest Market Solutions, up next.
When it comes to total farm solutions, AGI has you covered. AGI offers complete systems and solutions with industry-leading products to meet your needs. From Weststeel and MFS storage bins to Nico dryers, Westfield augers, Batco conveyors, Hutchinson grain loops to SureTrack for seed selection, planning, grain management, and marketing. AGI has the solution for you. Visit aggrowth.com for more information.
the best talkers in ag, including you. Join the conversation on AgriTalk. Call us at 855-4TALK-AG.
I do not remember Bruno working with chickens. Was it ever
it's
done?
From his early stuff. His early stuff. This is a deep cut. It's a demo.
Deep
I believe
cut.
Is what it is.
Bruno Mars.
Yep.
Got it.
Well, and the thing is, they couldn't afford the chickens in the studio. The label was like, you're a great talent, but the chickens. It's just too much. It's just
chickens,
too much.
Mm-hmm. Too much.
Yep.
We'll have Davis work it in post.
We'll work it in post. Mm-hmm. Mm-hmm. This is what I do.
Love it.
I repair crushed dreams.
Welcome back to AgriTalk. I'm Chip Flory. That is Davis Michelson. And this is AgriTalk. Okay.
It is.
Yeah. Let's get into the conversation because we've got a lot of ground to cover. Brian Hoops, Midwest Market Solutions, is our guest analyst today. Brian, welcome back. How are you?
Hi, Chip. Good to talk with you guys. How have you been?
Good. Yeah, it's been a little while. I want to start with your perception, your take, whatever you want to call it, on crop conditions and relate it back to those yields that USDA is working with, the trendline yields.
Okay, so you can take a few things away from what the USDA is saying, I think, this year. Our all-time best yield is 176.6 bushels per acre. That was 2017. 2018, we had 176.4. And we've never been higher than that. And last year was 172. And you look at the conditions this year, they're 8 to 10% lower than they were at this time a year ago for both corn and soybeans. And the USDA is at 179.5. So they are well above last year as far as yields go. And they're over 3 bushels better than our all-time best ever yield that we've ever had. So I think they've been very conservative this entire last calendar year as far as increasing export demand, lowering yields, anything that has to do with corn and soybeans. They've been very, very conservative. That would include, changes in the crush, changes in feed usage. It's been a very slow affair with the USDA taking kind of a wait-and-see approach. And I'm not surprised they've done that with the corn and soybean yields. They've taken a very slow approach here as they go into these balance sheets. And I think there's reasons for them doing that, such as if they start tightening yields up enough, we're going to see a real scare as far as prices go and a need to ration the crop. So yeah, they're well above the pace the best ever yields. They're well above what we saw a year ago, and I think there's going to be some room for adjustment. Now there is going to be some places this year, just like every year, that has outstanding conditions and are going to produce a really big crop. But there's a lot of areas, especially when you talk about the Dakotas and northern Minnesota. June 30th acreage report said 1.5 million acres of corn would be planted in addition to what we had talked about in March. And those acres, 1.2 out of the 1.5 million, are in the Dakotas and in Minnesota. So it really makes you question and wonder how good those yields are going to be on those additional seeded acres. North Dakota is a huge producer of both corn and soybeans, and they are having their worst drought in quite some time, probably one of the worst they've ever had. So I do think USDA has to come down, but it's going to be a very slow pace that they come down with.
Yeah. We had a conversation this morning on the free-for-all in the first hour of AgriTalk about the timing and how USDA may be picking and choosing when certain moves need to be made. This move on if you're right, and if many out there are right, Brian, and we do see the national average corn yield pull back from that 179.5, let's say get it into let's just throw 175 out there so that we've got something easy to remember in the conversation here. We pull it back to a 175. When do you do it? Because if you do it too soon and you get too big of a price reaction, then all of a sudden you're shutting off your export demand, you're shutting off your domestic demand, you're shutting off all of that side of the balance sheet. at a time when it hasn't developed yet. It's walking a tightrope, isn't it?
Yeah, they have an interesting job to perform because for all those factors you just mentioned, they want to kind of control that, because if you use a 175 yield, your balance sheet probably shrinks up to close to 1 billion bushels, maybe a 1.25 or 1.5 billion bushel carryout. We're talking some tight stocks, very tight stocks to usage ratio at that point. So you're right, they don't want to do it all in one fell swoop. That could cause a real huge reaction in our futures, and prices, export demand would slow down. It would certainly hurt our feed usage industry. Ethanol consumption would slow. All these factors, the demand would slow down, and so we don't want to see that. We want to see, I think, what they're doing. Even though it's frustrating that the USDA is making very slow, methodical changes, it's probably in our long-term best interest to make these slow changes that won't really give us too much volatility too fast, because we have a lot of volatility already in these markets. I think I saw a stat the other day that corn futures have not traded in a single-digit trading range since April, sometime in April. So we've had big ranges, even though sometimes when the trade volume is kind of quiet, big ranges are still taking place. And I think the USDA, as I said, very frustrated with them, but I think it is, it's in our long-term best interest not to change this balance sheet so quickly, too fast.
Gotcha. It leads to a lot of frustration. There's no question about it. And we've got a caller on the line. We opened up a can of worms here is what it sounds like, Brian. Steve in Southwest Iowa is on the line with us. Steve, how are you doing today?
Pretty good. Been delivering some of my earlier priced corn, which always makes my day when the markets have done what they've been doing lately. But I just had a comment, the comment you made, Chip, about USDA's slowly adjusting things so that we don't kill our demand, and so they not necessarily. And my first gut reaction isn't that some form of a market manipulation to make sure that that the prices don't react to the truth, but yet react to the perceived direction of the estimates?
Well, I think, and I get where that question or that comment comes from, Steve. I really do. That's why we look more at the cash market in times like this to see what it is telling us, because the futures market it has gotten to, and Brian, check me on this, okay? But with the increased participation of the analog driven, or the analog isn't the right word, the computer driven trading. There you go.
Algorithm.
It makes me wonder if, and Brian, we see the cash market react to the things that we are talking about with, the lower yield expectations. I mean, there's a yield futures quote or quote unquote out there that's trading like at 176 or something like that for a national average yield right now, Brian. So the market, I think, is making adjustments for it. There's a reason that we're at 550 in D's corn, and it's not because export demand has been all that outstanding over the past month. It's because we've still got some concern in here about the size of the crop, right, Brian?
Yeah, you're exactly right. We've got a pretty substantial weather premium built into the pricing structure. Okay. And it's not so much demand driven, even though the demand has been very steady with when you count feed usage and you count exports and you count ethanol production and demand increasing. It's more of a function of this weather premium that we put into prices. I think your baseline is probably close to that $5 level, and that, if we get below that price, that's a pretty clear indication the market is willing to take some premium out of the weather, because weather has either improved enough or we're assured of a 176 or above yield. And it's when we're trading like in this 550 or we get up into the 570, 580 range, that's where we start to talk about adding weather premium because some adverse weather. So, a lot of the long-term weather models, when we're talking 15 days out, 30 days out, they are looking at more of a hot and dry scenario, almost a return to what we saw in June. And that's when we start talking about these premiums being added because of weather.
Gotcha. Steve, again, I get where your question, your comment comes from, but the demand that we're talking about on the export side hasn't developed yet. So USDA has always been slow to put something in that hasn't developed yet. On the yield side of things, they haven't done a survey. They're going to do their first survey for the August crop production report. So it's part of the process that determines the timing on when these changes are made. It's not manipulation. It's part of the process. I hope that makes sense. Thanks, Steve.
Oh, yeah,
Appreciate that.
It does. Oh, that's fine. It does. It makes some sense. The other thing I always think about.
Hey, buddy, we got a break. We got Brian Hoops.
Let's take a look at today's winners and losers by percentage. Soybean meal gained 0.14% as soybean futures firmed 0.5. Soybean oil climbed 1.49, and once again the wheats dominated the upside movers. Hard red wheat up 1.76, soft red up 3.05, and spring wheat sprang into the top spot, up 3.33% on the day. To the downside, oats fell 0.8, and corn, our biggest decliner, down 1.46%. Livestocks, the pork cutout firmed 1.12%. Lean hogs up 1.29. Non-fat dry milk topped gainers 1.40% higher today. To the downside, fat cattle futures fell 0.78. Butter continued to soften off 0.79. Feeder cattle sank 1.11, and Class 3 milk rounds out declines off 1.30% on the day. The winners and losers by percentage is a service of Pro Farmer. Give it a look at tryprofarmer.com.
Opinions expressed on AgriTalk do not necessarily reflect the views of Farm Journal Broadcasting, affiliate stations, or sponsors. The truth is hard to come by these days, unless you listen to AgriTalk.
Welcome back to AgriTalk. I'm your host, Chip Flory. Got Davis Michelson with me. We are having a conversation with Brian Hoops from Midwest Market Solutions. Before we get back to Brian, let's go ahead and recap how the market's closed.
Chip, September hard red winter wheat 11 1/4 cents higher today, 6.51 1/2. September spring wheat closed at 9.17 1/4, up 23 1/4 cents. September corn futures were 8 1/4 cents lower at 5.56. March corn closed at 5.59 1/2, down 4 1/2 cents. August soybean futures 7 1/4 cents higher, 14.54 3/4. November bean futures closed at 13.91 3/4, up 11 3/4 cents on the day. October cotton 86 points higher at 90.70. And on the livestock side, August live cattle 95 cents lower, 120.17 1/2. August feeders $1.75 lower, 155.62 1/2. And August lean hogs $1.35 lower today, 105.65 at the close. That is your quick market recap. Now back to you, Chip.
All right. Thank you very much, Davis. We are having a conversation with Brian Hoops, Midwest Market Solutions. Brian, let's handle a couple from Twitter here real quick. This one from A. Klein Farmer 84 says the PNW normally raises some huge state average corn yields. Will they be able to do that with the drought and heat in that area?
I'm going to say absolutely not. They've got a lot of heat, a lot of dryness in that area, too much for it to overcome. So, a lot of that corn in Idaho is irrigated out of the Snake River, and that I think is an area that they'll have a pretty decent crop. But if it's not irrigated in that area, I certainly think they're going to have to bring yield potential down in those areas.
Yep. Yeah. The thing is, though, there's not enough acres up there to really have a major impact on the national average yield. So it is something that we're going to keep an eye on, though, Adam. No question about that. This one from @Calvin Staggy. He says, what do you see September corn doing before expiration? This is that old crop play that I was getting at before.
Yeah, that's a good question. I saw that on Twitter myself. That question, and I think the question is, July was hovering around $7, trading above it before it expired, just below it. Can September get to that area? I don't think it's going to have that much thrust. July is considered an old crop contract. September is kind of the hybrid. the old crop in some areas of the country, like, in the northern plains and northern Midwest, but in Texas, that's their new crop. That's their delivery period. They're going to have a lot of corn that's going to be harvested. They've got a really good crop there this year in a lot of areas. They're going to have some corn get harvested and being delivered. So that is going to keep a lid on September from rallying too much. So, we may get lucky and get back to the $6 area. But I just don't see $7 in the cards unless, it quits raining across the Midwest.
Yeah. And that SEP-D spread has gotten down to 4 cents. Brian, what's that telling us? That September's trading as a new crop?
Yeah, it's some of it is starting to be traded as a new crop. It lost quite a bit of ground today. A lot of bear spreading taking place. I think that's a kind of a bad indication that maybe with the slowing of our export business, that market is trying to look ahead and sense that USDA has a pretty aggressive sales pace on our books. We may have to roll some of that old crop into the new crop marketing year because most of it hinges on China. They've got a lot of corn that's on the books that has not been shipped yet. And it's very possible that they're not going to be able to take deliveries, through the end of August. That's the end of this marketing period. They probably are just going to end up rolling some of that into the new crop marketing year.
Yeah. The thing that might that gives us a chance of loading up a big chunk of what has already been sold to China is they're not going to be able to get anything out of Brazil, are they, Brian?
Well, that's the one thing that the USDA we talked about earlier, that they were very slow to make adjustments. They're still around 93 million tons for Brazil's corn crop, where a lot of private estimates are 83 to 85. And as these numbers come down for Brazil's corn, that means they have less exports available, and that opens the door for more new crop corn exports. So, that the USDA, I think, will start to make some adjustments, but, they have new crop corn exports at 2.5 billion this year. Right now, the old crop is at 2.85, and with Brazil's crop struggling, I think there's a really good chance we add at least, 150 to 250 million bushels back into new crop demand over the course of this year, and that would tighten up our balance sheets further.
Okay. So recently, it doesn't feel, it is. The soy complex is outperforming the corn market. Why is that happening?
Yeah, well, soybeans are more of a crop of August rather than the corn market. We're getting a lot of corn being pollinated under some ideal type conditions this week and through the next couple of weeks. There's a lot of moisture that's been thrown down in parts of Iowa that have been dry. Now they're going to look at tasseling and pollinating. They should be able to get through the next couple of weeks of pollination in pretty good shape. But the longer-term forecast, when soybeans want to reproduce, a little bit more concerning. So the soybeans, I think, will gain against corn in here, adding that premium that we talked about earlier, wanting to put that incentive in there that if this rain doesn't materialize and the soybeans do not have very good yields, that we're already higher priced and we are already in that rationing of demand phase.
Okay. What about the influence of the wheat market on corn? How do you see that playing out? Because, this wheat market really performed this week.
Yeah, it really did. And the big gainer, of course, is Minneapolis spring wheat. We have clients there that are talking about harvesting already next week because they've had such little moisture. It's going to speed that maturity along. And, those heads are not full of kernels by any means. Very small heads this year, which is going to turn into very disappointing yields. So USDA's, I think, at only 3% abandonment rate. There's probably going to be much, much more than that, which is going to pull yields down, production down, and ending stocks will get even tighter and tighter, especially for that spring wheat belt. We will see, I think, some millers using winter wheat instead of the spring wheat because of the price justification, and that demand for the winter wheat should translate pretty well for corn. We talked about corn and wheat competing for feed rations sometimes. Well, wheat's going to be used as a blended with the milling wheat this year, and that is going to keep that market pretty price competitive to the corn market and should be a supporting feature.
Okay. Take all of that, Brian, throw into it your weather outlook, and talk about what strategies you think are the right strategies to consider for risk management right now.
Well, the go-to answer on risk management strategies is to use options. That's what everybody loves to say, because it gives you that risk factor of you kind of eliminate or reduce some of your risk by buying puts or making sales and buying calls, and then you still have potential to reown the crop, and that's certainly a great strategy. The issue this year, because of the volatility and the big swings in ranges that we're seeing with all these markets, these options are very expensive this year. Back 20, 25 years ago, you could buy a pretty close to the money corn put for 10, 12 cents. This year, 10 cents is going to be several dollars out of the money. It's very expensive to do something like that. So it's a little harder on the producer to manage that risk via options. But I think this year you're going to have to step back and look at your yield potential and these pricing opportunities. If you have been fortunate enough to get some of these rains and you're looking at $5 out of the field corn, there's some reasons you need to be making those sales right off the combine, and you should be locking that in. I think there will be a lot of producers that will be looking at these supply-demand fundamentals, the fact that maybe USDA is underestimating our corn exports and maybe overestimating corn yields, and are going to be storing this crop and locking the bins tightly shut this year, and waiting for basis to improve. And I think that's going to be a pretty good strategy, especially in the Western Belt where it's been extremely dry.
Yeah. And, the other thing, and you said it without really saying it, is when you can lock in or secure the profit that you can lock in and secure right now on those forward contracts for harvest delivery, why not do it on some of them, right?
Yeah, you really need to. You don't want to. Yeah. If we're all wrong here, and USDA comes out with 180 bushel corn yield, prices are going to plummet, and we really don't want to miss out on these opportunities, because there is a tight basis already. There's clients telling me you can get anywhere from $5 to $5.50 delivered right out of the field, kind of depends on your area. So, boy, you don't want to let that opportunity go by.
Yep. Okay. Can Hogs had a good week, up like $4. Can we keep it going next week?
Yeah, I think so. The hog index is up in the 111, 112 range, and the August futures are certainly discount to that. They need to narrow up that discount. July's gone off the board. August lead contract, it's only a month away from expiration. Unless the cash market's going to fall apart, which I don't look for it to happen, the futures need to climb up and align up to that index.
Yep. Okay. I agree. What about those back month contracts? Trading around that $85, $88 range. Any hope that we could see some strength come into those markets?
Yeah, those back months, it's going to hinge on exports, and we saw marking unit low in our shipments this week, and that's the last thing that we want to see. Those back months, we need to be continuing to export our product. I think we did slow down our exports because of these higher prices that we went to. June, July, August, up until the 115 over 120 for a few days. That did slow our demand, and I think those values will be still there for December, February hogs, and they can rally back based off of that stronger demand trend.
Excellent. Good stuff, Brian. Thank you so much, buddy. We'll talk to you again soon.
Talk to you soon. Thanks a lot, Chip.
You bet. That's Brian Hoops, Midwest Market Solutions. Okay, when we come back, we're going to put a wrap on what was another volatile week and take a look at the weather forecast right here on AgriTalk.
Never miss a story. Text NEWS to 31313 to have today's top stories delivered to your phone. Welcome back to AgriTalk, everyone. So glad you've tuned in today on this Friday afternoon. Davis Michelson here with Chip standing by. Chip?
Yes.
Brian Hoops, Midwest Market Solutions. Let me, as is customary for me, let me rewind it all the way back to the front end of the conversation, because usually by the ends of the conversation, we're talking some heavy duty stuff and really getting into it, but the starting points often there are little things that I don't want people to miss, and today was no exception. Brian was he did a really, really smart thing in looking at yield data, crop condition data, just sort of from a historical perspective, and then took a look at what USDA has posted for their yield estimates on the corn and soybeans for this year, and where you boys landed on that was a discussion of USDA's sort of conservative approach, in putting out their forecasts.
Yeah, and it's a lot of it has to do with, as I said, it's because they have a process that they must follow. Now, I will tell you this, and Brian Grady, Pro Farmer editor, put it on the front page of Pro Farmer newsletter this week. Yep. There are lawmakers that want to take a deep dive into how USDA and the National Ag Statistics Service and the World Ag Outlook Board do things. And they are reaching out to Pro Farmer for some comments about what USDA should be looking at. Now, so what Brian is doing is he's turning it over to the members of Pro Farmer and saying, send me an email, editors at profarmer.com, send me an email, and let me know what you think USDA should be doing differently going forward. And I wish he could have put asterisks, don't just say do a better job. Asterisks, don't just say do it in a more timely fashion. Yeah. Because we had this conversation this morning on the first hour of the show too, and Jim brought it up. And, for a long time, Jim was reluctant. Jim Wiesmeyer, Pro Farmer Policy Analyst, was reluctant to jump into this conversation. I think for many reasons. And here about a year ago, he just decided, you know what? Nope, I'm not going to stand out of this conversation anymore. USDA needs to do a better job. Some senators have suggested that we need to put more money into USDA, more money into NASS, more money into the World Board, so to give them the tools that they need to do a better job. Wouldn't that be great? I mean, we've talked to Lance Honig, the chief of the crops branch at USDA, NASS, many, many times on the show, and all he talks about is, well, if we had more money, we might be able to do more of that. Look at what they did here a couple of years ago, and I don't know if this is such a bad thing or not, but what they did a couple of years ago was they stopped doing the yield plot observations for the August crop production report. They still do a survey, so it is still a survey-based estimate that we will get on crop production in August, but it does not include any of the objective yield plot data. They wait until September to do that now. So they got rid of a month's worth of costs of going to those objective yield plots to do it. So is money the lubricant that we need for USDA to do a better job? Maybe it is. Maybe it is. But after we had the conversation this morning, I went and checked out on Twitter, and there was quite a bit of conversation. There was some conversation out there. One of them basically said, listen, as soon as you fill out one of the surveys, you just get inundated with them, and they bug you the worst when you're trying to work 80-hour plus weeks. Don't need any of that. The other one is, as soon as I get it, I throw them away. If I don't throw it away, I put bad information on it. Well, it's like we were talking with Haney about it this morning. Those surveys are only as good as the information that are coming in. So if it's a complete gigo situation. If you've got garbage coming in, you're going to have garbage coming out. So I don't know, dude. But the slow roll at USDA is a lot of it has to do with the process that has to take place before they can make changes. Well, one of the things that Jim talked about this morning was slow to respond to to industry talk that China corn imports were going to be much, much larger than what they had in, say, 6 months ago. Well, they were slow because China hadn't bought much. Once they started to buy it, then it was reflected. But it's frustrating. I get it.
Yes.
It's not easy to do.
people would be equally suspicious if USDA abandoned that sort of conservative approach. I'm talking on the yield side now, and decided to be super aggressive, super ahead of the curve, and put it out at 165. There. You happy? You happy?
Right.
Still
$7 corn and no demand.
Yep.
It's tough. It is tough. National Weather Service, 6 to 10 day outlook, July 22nd through the 26th, has above normal temperatures from Indiana, Michigan, western Kentucky and Tennessee, all the way west through the Corn Belt. You get into below normal temperatures down in Texas. Below normal precipitation, North Dakota, South Dakota, Nebraska, Kansas, down into Oklahoma, Missouri, Iowa, Minnesota, Wisconsin, and western half of Illinois. Michigan, according to this, you're going to have to continue to deal with some soggy conditions there. The 8 to 14 day outlook, this is for July 24th through the 30th. Above normal temperatures across the entire Corn Belt. The exception there would be the eastern 3/4 of Ohio. Otherwise, we've got extreme heat expected. 70% odds of above normal temperatures are in the forecast for North Dakota and northern South Dakota, but the above normal temperatures are throughout the Corn Belt. Below normal precipitation, say it with me again, North Dakota, South Dakota, Nebraska, Kansas, Missouri, Iowa, Minnesota. Tough. That's a tough second half of July if that's what we get for this corn crop. All right, thank you so much for listening today. That's from me, that's from Davis, and that is from producer Big Apple, Joe Stackler. Monday morning, AFBF President Zippy Duvall and Greg Peterson. Monday afternoon, Ben Brown. Have a great weekend, everybody.